Buying a car is one of the biggest purchases most people will ever make. And the way you choose to finance it can either save you thousands of pounds or quietly cost you far more than you realise. Most people look at the monthly payment and stop there. But the smartest approach is to step back and look at the total cost of ownership, because that's where the real differences show up. Now, to make this really clear, let's imagine you're buying a car that costs you £20,000. Now, we'll keep the same car throughout this explanation so you can see how each option compares and what the long-term costs look like. Now, strap in, you have 7 options. The first option is paying in cash. If you've saved up the full £20,000, you can simply hand it over to the dealer and drive away with no finance agreement at all. This is the cheapest way to buy a car because there's no interest, no fees, and no hidden charges. You own the car outright from the very first day, and there are no restrictions on how far you can drive it, how you maintain it, or whether you want to sell it later. The only drawback is that it requires a large amount of money up front. And if you spend all of your savings on the car, you may leave yourself without an emergency buffer. That's why cash works best if you still have a healthy savings cushion after the purchase. In our example, the cost is simple. You spend £20,000 today, and that's the end of it. The second option is hire purchase, or often shortened to HP. With hire purchase, you normally pay a deposit and then spread the rest of the cost over fixed monthly payments. When you've made the final payment, the car is yours. Let's say you put down a deposit of £2,000 and finance the remaining £18,000 over 4 years at an interest rate of 8%. Using standard loan calculations, the monthly payment would be about £439.43. Over the 48 months, you would repay £21,092.76 in instalments. And once you add the deposit, the total cost of the car is around £23,092.76. That's just over £3,000 more than paying in cash. The arrangement is simple and predictable. But the catch is that you don't legally own the car until the last payment has been made. The third option is personal contract purchase, or PCP. Now, this has become one of the most popular choices in the UK. With PCP, you put down a deposit and then make lower monthly payments compared with hire purchase. But you don't automatically own the car at the end. Instead, you get 3 choices. You can pay what's called a balloon payment and keep the car. You can hand it back and walk away, or you can trade it in and start a new deal on another car. Now, sticking with our £20,000 example, imagine you pay a £2,000 deposit. The finance company assumes the car will be worth £6,000 after 4 years, so you're financing the depreciation and interest on the balance. At 8% interest, the monthly payments would be around £332.96. Over the 48 months, you would pay £15,981.84 in instalments. And when you add the deposit, that comes in around £17,981.84. If you choose to keep the car, you then pay the balloon of £6,000, bringing the total to £23,981.84. If you hand it back at the end, the total cost is £17,981, which looks cheaper, but of course you don't have a car to show for it. The fourth option is leasing, sometimes called personal contract hire. Now, leasing is more like renting than buying. You put down an initial rental and then pay a fixed monthly fee for a set period. And at the end, you simply hand the car back. Using our example, a typical 3-year lease on a £20,000 car might involve an initial payment of, say, £750, followed by 35 monthly payments of £250. Over the 3 years, that adds up to around £9,500. At first glance, that seems cheaper. But the difference is that you walk away with nothing at the end. You have no car to sell or trade in. So if you always lease, you are essentially paying to use a car permanently without ever owning one. Another choice is to take out a personal loan from the bank. In this case, the bank gives you the money, you can go and buy the car outright, and you repay the loan over time. The benefit here is that you own the car from the very beginning, even while you're paying back the loan. So suppose you borrow £20,000 over 4 years at 6% interest. The monthly repayment would be about £469.70p. And over the 48 months, you would repay about £22,545. This is £2,545 more than paying in cash, but it's often cheaper than hire purchase if you can secure a competitive interest rate. It also has the added advantage that you're not tied into a dealer's finance agreement. Now, sometimes car manufacturers offer what's known as 0% finance. Now, these deals are essentially an interest-free loan where you spread the cost without paying anything extra. If you're lucky enough to get such a deal on your £20,000 car over 4 years, your monthly payment would be about £416, and by the end you'd have paid off the £20,000. That's the same as paying in cash, but with the convenience of spreading the cost. The catch is that these offers are usually tied to specific models, and because the manufacturer is subsidising the finance, you may not get as much room to negotiate on the actual car price. And finally, there's the option of using a credit card. Now, while this is rarely the main way to buy a car, it can be useful for paying the deposit. In the UK, if you pay at least £100 of the car's cost on a credit card, you get Section 75 protection, which means the card provider is jointly liable with the dealer if something goes wrong. However, unless you have a 0% deal and can clear the balance quickly, credit card interest rates are extremely high, often 20% or more. For example, if you finance the full £20,000 on a credit card at 20% and only made the minimum payments, you could end up repaying well over £40,000 across many years, which is why this method is almost never recommended. Now let's step back and compare. Buying the car outright in cash costs £20,000. Hire purchase would cost you around £23,092 over 4 years. Personal contract purchase comes in at £23,982 if you keep the car, or £17,982 if you hand it back at the end. Leasing looks cheaper at £9,500 over 3 years, but remember, you walk away with nothing. A personal loan would cost roughly £22,545. 0% finance costs the same as cash, £20,000, but lets you spread the payments. And a credit card should only really be considered for deposits or very short-term borrowing. So which is the best option? If you have the savings and won't wipe out your emergency fund, paying in cash is the cheapest and simplest way. If there's a genuine 0% finance deal, that's just as good, and in some ways better because it preserves your savings. If you do need to borrow, a low-interest personal loan or hire purchase are usually the next best options because they both give you ownership of the car. Personal contract purchase and leasing work well if you want the flexibility or you'd like to change cars regularly, but they're rarely the most cost-effective. And here's one golden rule of personal finance. Try not to spend more than 10 to 15% of your monthly take-home pay on all car costs combined. That includes not just finance payments, but also insurance, road tax, servicing, and fuel. So the next time you're car shopping, don't just focus on the monthly figure the car salesman shows you. Take a step back, look at the total cost over the full term, and ask yourself whether you'll actually own the car at the end. Because in the long run, the way you finance a car can make just as much difference as the car itself. If you found this video helpful, don't forget to like, subscribe, and hit that bell icon for more videos just like this one. If you're keen to learn more about personal finance, be sure to check out the industryportal.com, link in the description below. Thanks so much for stopping by, and as always, keep growing, keep learning, and I'll see you in the next video.